This is Manjula, Assistant Professor, Department of Commerce from St. Joseph College of Arts and Science for Women, Osur. Today we have to see about the topic of concepts and conventions of accounting. First, let's see accounting concepts. Business entity concept, money measurement concept, going concern, accounting period, accounting cost concept, dual asset concept, matching concept, realization concept, accrual concept. And first, we have to see business entity concept. This concept assumes that for accounting purposes, the business enterprises and its owners are two separate independent entities. Thus, the business and personal transactions of its owner are separate. For example, when the owner invests money in the business, it is recorded as liability of the business to the owner. Similarly, when the owner takes away from the business cash or goods for his or her personal use, it is not treated as business expense. Money measurement concept. This concept assumes that all business transactions must be in terms of money, that it is in the currency of a country. In our country, such transactions are in terms of rupees. Thus, as per the money measurement concept, transactions which can be expressed in terms of money are recorded in the books of accounts. For example, sale of goods worth rupees 2 lakh, rent paid rupees 10,000, etc. are expressed in terms of money, and so they are recorded in the books of accounts. But the transactions which cannot be expressed in monetary terms are not recorded in the books of accounts. For example, seniority, loyalty are not recorded in the books of accounts because this cannot be measured in terms of money, although they do affect the profit and losses of the business concern. Going concern concept. This concept states that a business firm will continue to carry on its activities for an indefined period of time. Simply stated, it means that every business entity has a continuity of life. Thus, it will not be dissolved in the near future. This is an important assumption of accounting as it provides a basis of showing the value of assets in the balance sheet. Accounting period concept. It states that all assets are recorded in the books of accounts as their purchase price, which includes cost of acquisition, transportation, and installation, are not at its market price. It means that fixed assets like building, plant, and machinery, furniture, etc., are recorded in books of goods at a price paid for them. Dual asset concept. Dual asset is the foundation or basic principle of accounting. It provides the every basis of recording business transactions in the books of accounts. This concept assumes that every transaction has a dual effect, that is, it affects two accounts in their respective opposite sides. Therefore, the transaction should be recorded at two places. It means both the aspects of the transactions must be recorded in the books of accounts. Thus, the duality concept is commonly expressed in terms of fundamentals accounting equation, that is assets equal to liability plus capital. Matching concept. The matching concept states that the revenue and the expenses incurred to earn the revenues must belong to the same accounting period. So, once the revenue is realized, the next step is to allocate it to the relevant accounting period. This can be done with the help of accrual concept. If the revenue is more than the expenses, it is called profit. If the expenses are more than the revenue, it is called loss. That is, this is what exactly has been done by applying the matching concept. Realization concept. This concept states that revenue from any business transaction should be included in the accounting records only when it is realized. The term realization means creation of legal rights to receive money. Selling goods is realization, receiving order is not. In other words, it can be said that revenue is said to have been realized when cash has been received, or right to receive cash on the sale of goods or services, or both has been recorded. Accrual concept. The meaning of accrual is something that becomes due, especially an amount of money that is yet to be paid or received at the end of the accounting period. It means that revenues are recognized when they become receivable, though cash is received or not received, and the expenses are recognized when they become payable, though cash is paid or not paid. Both transactions will be recorded in the accounting period to which they relate. Accounting conventions. There are four accounting conventions. First one is consistency, second one full disclosure, third one materiality, fourth one conservatism. Convention of consistency. The convention of consistency means that same accounting principle should be used for preparing financial statements year after year. A meaningful conclusion can be drawn from financial statements of the same enterprise when there is comparison between them over a period of time. But this can be possible only when accounting policies and practices followed by the enterprises are uniform and consistent over a period of time. If different accounting procedures and practices are used for preparing financial statements of different years, then the result will not be comparable. Convention of full disclosure. It requires that all material and relevant facts concerning financial statements should be fully disclosed. Full disclosure means that there should be full, fair, and adequate disclosure of accounting information. Adequate means sufficient set of information to be disclosed. Fair indicates an equitable treatment of users. Full reference to complete and detailed presentation of information. Thus, the convention of full disclosure suggests that every financial statement should fully disclose all relevant information. Convention of materiality. It states that to make financial statements meaningful, only material fact, that is important and relevant information, should be supplied to the users of accounting information. The question that arises here is, what is material fact? The materiality of a fact depends on its nature and the amount involved. Material fact means the information of which will influence the decisions of its users. Convention of conservatism. It is based on the principle that anticipate no profit but provide for all possible losses. It provides guidance for recording transactions in the books of accounts. It is based on the policy of playing safe in regard to showing profit. The main objective of this convention is to show minimum profit. Profit should not be overstated. If profit shows more than actual, it may lead to distribution of dividend out of capital. This is not a fair policy and it will lead to the reduction in the capital of the enterprise. Thank you.